Morning everybody, thanks very much for joining us because we appreciate it's a really busy market at the moment with lots going on. My name's Aidan Walker, I'm Senior National Account Lead here at Skipton and I'm delighted to be joined by Jen Lloyd, Head of Products and Proposition. Morning to you all.
Good morning.
So this morning we're going to be talking through the latest findings from the Skipton Home Affordability Index and hopefully looking at some potential solutions from that data for you as brokers to help some of your first time buyer clients. So Jen, first question for you, a couple of findings from the index and the latest data that we've got. So 3 decades ago, back in the 1990s, glorious time.
Amazing time.
Yeah. 1 in 4 first time buyers were under the age of 25.
Yeah.
And now it's just 1 in 15. Did that surprise you at all when you saw that data?
I would say no, it doesn't surprise me, but it's still kind of just it's quite confronting when you think about it, the fact that the market for under 25s has pretty much collapsed. It's almost non-existent, and that just speaks to increasing challenges around getting that important first step onto the ladder. It's clearly a very challenging time and has been for a long time, and it's not a straightforward, easy problem to solve. It requires quite a lot of different interventions. But yeah, no, I'd say not surprised, but when you see the data, it's quite confronting, and it kind of points to the broader challenge, which is, you know, getting the keys to your very first home is increasingly out of reach for a lot of people. Yeah,
definitely. No, it's quite stark statistics, definitely. And linked to that a little bit, so we're now at a point where 52% of first-time buyers are relying on 2 or full-time incomes to make affordability work, compared to 40% in the 90s.
Yeah.
Again, what's your views on that?
I think again it just kind of demonstrates that affordability is a key barrier for many would-be buyers, and the likelihood of being able to get onto the property ladder with a single income is increasingly challenging. I think we have to be careful. We don't want to be all doom and gloom, and you know, there are a lot of reasons to be optimistic and hopeful. And I think that one of the things that pleases me is the resilience of the first-time buyer market in general. You know, it remains a key segment, and we see that really maybe amongst first-time buyers that will and that kind of determination to get onto the ladder is really strong. I suppose in the role that I do, it's thinking about what can we do to help those people, the people that maybe do want to buy on their own, or the people that, you know, don't have help from the bank of mum and dad. How can we think about helping them get their keys as well?
So that seamlessly takes you on to the next question. Wonderfully done. So are there any sort of products or solutions that brokers might not have heard of that could help this area of the market?
Yeah, I think I'd hope that many people joining us this morning will be familiar with what's known as joint borrower sole proprietor. Now, obviously, we renamed our JBSP proposition a couple of years ago, which to make it more kind of consumer friendly. So we called it Income Booster. And actually, I might just turn the tables a minute and ask you to kind of speak to the details around how that works and how that could be a good solution for people that maybe don't have access to a big deposit, or haven't got kind of like the amount of earnings that they'd need to meet affordability kind of on their own. Like, talk to us about Income Booster, how it works.
Okay. Yeah, so it's a really flexible offering from us. We were one of the first lenders after COVID, really, who came into this space, and now quite a few lenders in it, which is great to see. We will allow up to 4 applicants on the mortgage. We use 100% of all 4 incomes, and those people coming on to support the person or persons living in the property, they don't necessarily need to be a relative. So whilst the most common scenario might be a parent helping out one of their sons or daughters, we are seeing more and more common scenarios where it might be uncles, aunties, cousins, or even friends, modern families, modern relationships. So it really is that flexible from that.
And the way that it works is that you have the people that are actually borrowing the money and named on the mortgage, so they're going to live in the property and it's their home, and then you've got supporting borrowers that are named on the mortgage but not on the deed.
Yeah, correct.
Which makes it different to maybe like a guarantor mortgage or something like that.
Yeah.
Excellent. Yeah, I love that. So yeah, we've been really pleased to see that as kind of popular, but I think sometimes it's not fully known about, which is why I wanted to highlight it this morning. I suppose the other area that helps, it would be shared ownership. So I think my view is that we're going to see increasing prevalence of things like shared ownership, which, for anyone that doesn't know, is a government-backed scheme whereby if you've got maybe a smaller deposit, you can opt to buy a share of a property rather than the entire. So you need a smaller deposit by proxy then. And then you also have the opportunity to what we call staircase out. So if you get your foot on the ladder, get into your property, you'll be paying part rent and your mortgage, but then you can also buy increments up to full ownership if you wanted to. And I think that is a recognition of the fact that the market is more complicated, people's situations are more kind of varied, and the traditional route to home ownership is not necessarily the same as it would have been in the 90s or even 10 years ago. So I think shared ownership is something that we'll see potentially more growth in that area as well.
Yeah, very much so. Yeah, we've seen that with a lot of inquiries with our BDM team recently, definitely. So back to the index and some more findings around that. So one of the most interesting ones for me was the average deposit for a first-time buyer in terms of the amount that they need to find.
Yeah.
It's more than an annual salary, so we're talking substantial figures.
Absolutely.
Yeah. What's your views on that, and what potential solutions are out there to help people where they don't necessarily have access to that amount of money?
Yeah, I think the ability to save a deposit is definitely a massive barrier for many would-be buyers, and that's where I would say our track record mortgage really comes into its own. So that was a product that we launched back in 2023, very much in recognition of the fact that people who have been renting for an amount of time have proven that they can afford to pay their rent every month in full on time, but they may not have the ability to also then save, you know, £50,000 deposit that they need to get onto the housing ladder. Track record is a product which enables borrowing up to 100% loan to value, and it only asks that people that want to utilise that product have been living in rented accommodation for at least 12 months. They've got that record of paying rent, and if we take that and say, well, okay, you've got that track record, therefore we'll look at you and consider lending you 100% of the property's value, therefore you don't need to put a deposit down at all. They can put a small deposit down if they want to, but if they haven't got one, that's absolutely fine. And the way that we also kind of control the affordability is through the rent to mortgage payment calculation. So when we first launched, we said, this is a bit of an unknown. We're going to go with, right, well, if you've been paying your rent, your mortgage needs to be no more than that. Now, we went to market with that. We're able to build the data and kind of learn in terms of what we're hearing back from our brokers. And what we found was actually the quality that we were seeing coming through, combined with the fact that sometimes that was a bit too restrictive, meant we were able to broaden it. So now we've said, well, actually, your maximum mortgage payment can be up to 120% of your average rent that you've been paying over the last 6 months. And that's meant that more people have been able to utilise the product. And we'll keep iterating it and keep kind of reflecting on feedback that we get from our brokers and from customers directly, and make sure that it remains fit for purpose. But ultimately, it's a product that answers a need, which is, I can't afford to save a deposit, but I can pay my rent in full, and I've got a track record of doing that. And maybe I haven't got access to the bank of mum and dad to give me, you know, a bit of a help in terms of getting that deposit together. With this product, you don't need that.
Okay. So when we first launched, like you say, it's nearly 3 years old now, track record. Yeah. And when that first came out, we were praised for the innovation. There wasn't a lot of any alternatives, like there wasn't really anything else out there. So it was very innovative. Can you give us sort of any insight and views on, is there any other potential sort of innovation that we've got out there, both ourselves and elsewhere in the market? Yeah,
I think it's been, I think the conversation and the kind of tone that is being talked about in the mortgage market has definitely shifted over the last 12 months. And I see an ambition from lots of different lenders to be more innovative. We've had the FCA's consultation paper, well, discussion paper, which was very far-reaching, but a lot of the things that we talked about in there pointed to a real appetite from the regulator to encourage innovation and think differently about how can we facilitate home ownership as an industry outside of the usual status quo, so challenging some of the ways that we go about things. And I think as a result of some of the push from the regulator, we've seen lots of lenders innovating when it comes to things like loan-to-income policy, which is obviously a massive win for first-time buyers. We've also been joined by YBS with their first-time buyer product. Santander, obviously the most notable recently in the last couple of months, launching their 98% first-time buyer product. And ultimately, I welcome that. I think it's fantastic. And certainly it's great that Skipton have kind of put ourselves on the map with track record and continue to be acknowledged as being innovative. Long may that continue, but equally what helps first time buyers is lots more innovation, so I would say I hope to see more of it, and we all need to think differently about how do we meet the needs of first time buyers that are evolving and very different to what they were even 10 years ago, and certainly back in the 1990s.
Yeah, very much so. So linked a little bit to that innovation, so like you say, it's been great to see a number of lenders coming in with different variations in the marketplace. We've seen it in terms of conversations out with brokers. The amount of options now available is absolutely a positive.
Yeah.
One that we came to market with last year, delayed start.
Yep.
And again, it was us trying to do something different. Just for those who are maybe not that familiar with it, can you just give us a bit of a recap on that concept?
Yeah, for sure. So the delayed start mortgage range answers a need which we found with research and talking to brokers and customers, which was a lot of the time first-time buyers are faced with overlapping rent and mortgage costs when they first take on a new mortgage. And we also found that the costs that you incur around the beginning of becoming a homeowner, things that you might not have really thought about, particularly if you're living in a furnished property, rented or with your parents, it's just the outlay initially is quite significant. And so we wanted to think about, well, what can we do to help with that? And so we offer a product whereby there's nothing to pay for the first 3 months. That was how we launched. And then subsequently, again, based on feedback and from speaking to brokers and taking that on board, we've evolved that product range now, and so now customers can choose anywhere from 1 to 3 months on a delay, depending on what's right for them. And we also, very much directly based on feedback that we'd had from speaking to brokers, as we do really regularly, combining it with track record. So if you do have no deposit, but you're in rented and you're wanting to make sure that for the first couple of months you don't have to have as high outgoings, then you can have that option now. So that's been really well received, and pleased with that.
Great. And obviously with what's going on in the market, it'd be remiss of us, like I said at the beginning, thank you very much for joining us, because we do appreciate how much of a busy time it is.
Yep.
In your role, Head of Products and Proposition, you'll have been very much seeing everything that's been happening over the last few weeks.
Yes.
I'd just be interested to sort of get your views in your role and what you've been seeing, and share with your brokers your views on the market and where it is at the moment.
Yeah, for sure. I mean, volatile doesn't even really cover it, does it? I think it's certainly felt... I mean, we always say don't be complacent, don't we? And I think that we've come to understand now as an industry that nothing is a given and expect the unexpected. But needless to say, I think start of the year, lots of optimism. We were talking about mortgage rates leveling off. We were talking about eased affordability and potential for rate cuts from the Bank of England. So things were looking pretty good. And then obviously we had the events at the end of February in terms of the Iran war, and I think clearly that's having massive repercussions across lots of different industries, but certainly from our point of view, it's given rise to real volatility. We're seeing lenders having to make really last minute decisions and changes, and I get that that's really hard for brokers, and so that is not underestimated how much hard work is going on in terms of keeping up with the amount of changes. And we're talking about now the potential for rate increase from the Bank of England, and that's clearly reflected in mortgage pricing, and we're seeing that elevated. But I suppose to reassure, whilst it is volatile and we are seeing higher mortgage rates, we're not in the realms of where we were back in 2023 when we peaked after the events of the mini budget in 2022. So I think there's a bit of room before we get to that level, and clearly we don't know what's going to happen. I think what we have to do is just try and stay optimistic, do what we can, and keep keeping our customers, your clients, front and centre. And really, my reflection in this is that more so than ever, first-time buyers should be speaking to brokers about their options.
Yeah.
We know that they have a preference to speak to advisors anyway to get that kind of full advice, but particularly now in such a confusing and changeable market environment, getting advice is never been more important. And so that's where clearly brokers have a massive role to play, and we'll continue to do everything we can to partner with them and make sure that we are supporting first-time buyers through the kind of brokers that we work with.
Very much so. Okay. I'll just have a quick look on, I'll bring my little laptop across, if you just bear with me, and we'll have a quick look and see if there's any questions in the chat. Just bear with me 1 second. Okay. So, question for you linked to that then, in respect of the challenges that the market's facing and everything like that. Like you say, really important. It does sort of emphasise the importance of advice.
Yep.
The first people, when we speak to brokers, when all this is happening, the media puts out a report of rates going up. The first people that a customer picks up the phone to is going to be their advisor to find out what's happening and what they do. It's worth talking about. It's linked to that. It's a big year for retention.
Yes.
So, where do we stand on retention? What's your view on that market and where it sits at the moment, and where it's going to move through as we go through the year?
I think what's interesting is if you'd have asked me at the start of February, I would have been saying it's going to be a big remortgage year. And you're right, there's a lot of market maturities happening. Clearly at Skipton we've got huge maturities this year. And I think what is more uncertain now is what the mix of PT versus remo is going to be, because clearly, start of February, rates coming down, affordability easing, cost of living easing, the kind of positive swing we were seeing in the market was being really largely driven by remortgage activity. I suppose, based on where we are right now and talking about potential cost of living constraints, rising rates, I think from a broker's point of view, I'd be thinking, well, we might see more PT activity than we'd have thought we might have done at the start of the year. Not a bad thing, just a shift, a different mix. But either way, clearly, we were very focused on first-time buyers at Skipton, but we're also really focused on retaining our existing customers and doing that through support from our brokers, absolutely. And so I think whether it ends up being a huge remo market or slightly smaller remo and a bit more PT, I think there's huge opportunity out there for advisors, and certainly we're here ready to work with them in terms of retention.
Definitely. And is there anything, I'm always conscious with these things because there'll be stuff that you're working on that we can't necessarily share.
Yeah.
But is there anything that that you've got on your pad that you're thinking about at the moment, or that you can share with the audience?
I think one of the things that we're reflecting on now, we've talked about how innovation is becoming more widespread, but I think if we think critically about that, the innovation has followed the existing norms within the mortgage market. So we're still seeing, a lot of LTI expansion, which is, like I said, a great thing. Is it innovative? Not sure. I think what we're thinking about at Skipton is the kind of construct of product and things like LTV bandings, fee structures, end dates, all of that kind of stuff that we take for granted in the market. We're challenging ourselves to think about how could it work differently. So that's a big piece of work for us. And then also thinking about how we service our customers, and therefore how do we support our brokers in giving that great service. Challenging ourselves to think differently about how we arrange ourselves around that is another kind of big focus area for us this year, alongside all of the usual new product development that you'd expect from us, of which I can't share, but needless to say, it's very much focused on reflecting the reality that is facing would-be buyers out there, and also taking on board all of the great conversation that we have with our broker partners on a regular basis, and kind of reflecting that in our products.
Okay. Yeah, it's like I say, it's a really interesting year. We were hoping it was going to be a stable year.
Yeah.
We know what's going on.
Yeah.
It was always going to be an interesting year anyway, because being out on the road like I've been, a lot of lenders' risk appetites have been naturally increasing. So we're starting to see a lot of policies overlap.
Yes.
So there was a time when you could walk into a team meeting and speak to a group of advisors, and Skipton would have sort of 5 or 6 USPs that we'd be doing and nobody else would. But now you go into these meetings and a broker could immediately name another 4 or 5 lenders who's doing a similar thing for you. So it's really interesting market at the moment where you've almost got your lenders criteria, but then you've also got your unofficial criteria underneath it, and it's where flexibility is key.
Yes.
And BDMs are becoming more and more important, and I'd be a massive advocate of you advisors out there. If you've not already got a relationship with your BDM, do reach out to them, because what lenders' criteria says on their website and our ability to take a view on things, particularly somewhere with ourselves at Skipton, we have got the ability to do that, and the BDMs can have those conversations with underwriters. A lot of the stuff you were talking about there, we're always willing to have a look at things from a fresh perspective.
I completely agree with you, Aidan, and I think the fact that more lenders are becoming more nuanced in their criteria and policy points is kind of a reflection of what's happening in terms of society at large, and the fact that, you know, borrowers are not, there's no such thing as vanilla lending anymore, I don't think. But you're absolutely right, and I think certainly from a Skipton point of view, you know, if there are cases that maybe brokers are unsure about, you know, what we'd consider, often, you know, we will look to find a way to a good solution, and it comes from that conversation. And I would totally echo your point about BDMs. You know, I always hear when I am out and about talking to people how responsive our BDM team is, and I think that if brokers out there joining us this morning are not utilising their BDM, like, please do, because I only have good things to say about them for sure. And you're right, it might say no in black and white somewhere, but actually sometimes it's in that grey that you can get to a good solution. It's always worth a conversation. That's where the real kind of finding a way forward comes from.
Yeah, smash it. A few questions starting to come through now,
Brilliant.
so I'll try and deal with some of these. Question from Joe Boo. Thank you very much, Joe.
Morning, Joe.
Looking at the deposit element for first-time buyers, do you think that Skipton would ever look at accepting a 5% builder incentive as a deposit for a 95% mortgage on a new build purchase? And he's put, sorry for putting you on the spot.
No, I'm fine with it. Bring it on. I think that's something that we are definitely thinking about, I would say. It's always worth considering, and it comes down to that challenging the status quo again, doesn't it? How can we reflect incentives and things like that in lieu of deposits? So I would say it's not a no, Joe. We're thinking about it, and watch this space.
Okay. Question from Sophie Dixon. Thank you, Sophie. So Sophie's heard some talk last year about a potential move towards a 6 times income LTI for LISA customers.
Oh, right, okay.
Is this something we're looking to progress, especially to help first-time buyers who aren't renting and struggling to borrow enough to purchase?
Yeah, so for anyone that doesn't know what LISA is, because whilst we kind of champion it at Skipton, it is not a fully well-known product. So Lifetime ISA is a product that launched by the government in 17, could be 18, a while ago. And the intention was to support would-be buyers to save for their deposit. You could save up to £4,000 per year, and then the government would give you a 25% bonus on top. So if you maximised it, £1,000 a year kind of from the government towards your deposit. We were the first provider of the cash lifetime ISA at Skipton, and since then have kind of gained hundreds of thousands of customers in the lifetime ISA, and they're all people that want to buy their first home. And so one of the things that we've looked at is how can we support our lifetime ISA customers in fully maximising their borrowing potential. And so higher LTI is definitely something that is we're considering it. I think it's another watch this space. But I think broader than just loan to income, it's thinking about, for those customers have been saving with us regularly towards their first home, how can we, with broker support as well, how can we help them to get their first keys? So I'd say I watch this space.
Okay, good answer. Okay. And another question here, which has been tagged onto one, is are we looking at any concepts around longer term fixed rates?
Yeah.
There are more and more competitors starting to come out and look at that.
It'd be good to get your thoughts on really long term fixes as well, Aidan, because I think I can totally see why there is a space for it and what the benefits are, you know, and clearly in other parts of the world, longer term mortgages are absolutely just standard. But in the UK, we are very much wedded to the 2-year, 5-year kind of cycle. And I think it's interesting, when rates start to go up like they are doing, you can look at it two ways, because you can say, well, this is nerve-wracking for people, and people that particularly who are facing rate shock. You know, we've got people listening to some call yesterday and they were coming off a rate of 140. I mean, amazing, but it's a significant step up in rate, you know, if you took your rate out at a good low point. And so you can see the space for a long-term fixed rate mortgage, and it would take away that uncertainty and kind of remove the need to be worrying every couple of years, where's my rate going to be, and therefore what's my monthly outgoings going to be. But the flip side of it is, when rates are going up, the palatability of saying, let me lock this in for 10 years, 15 years, 20 years, it's a different conversation. I remember back in the day, Lloyd's Halifax had a 10-year fixed rate at like 1.6. And I was thinking to myself, yeah, a bit steep though, isn't it? I don't know if I want to lock that in for 10 years. And, you know, in hindsight, I wish I had, you know, but it's kind of, it's a difficult thing to position, I think. So what are your thoughts on real long-term fixes?
It's an interesting one. I mean, like you say, innovation is always welcome in the marketplace, so there are different options out there. I think anything that gives advisors more sort of different options in their toolkit when speaking to customers, but it's all about coming back to personal circumstances. I read something interesting the other day about longer term fixes. It was a viewpoint on a particular article about, are they more suited to people at the end of their term?
Right, yeah.
So if you're maybe entering the final 10 years of your mortgage, locking in for the duration of that remaining term, that might be ideal for you. Is it right for first-time buyers when you know that they might be entering a few more milestones in their life? Maybe looking to start a family and things like that. So it all pulls us back to the key to advice and brokers, I think.
Exactly that. And I agree with you. Options are really important, and it is a good option for some people. I just think for whatever reason, really long-term fixed rates are not embedded in our mortgage market right now. Will that change? Maybe yes. You know, we'll see.
Okay. Question from Franz. Thank you, Franz. Thoughts on allowing elements of interest only for borrowing without reliance on huge amounts of equity. So there's therefore not a need to stretch LTI. And maybe 100% ownership of the property rather than shared ownership. So a bit of a broad brush, but your thoughts around interest only?
Interest only is something that was kind of covered in the discussion paper last year, and I think it's definitely a good solution, potentially quite restrictive based on current rules, and I think that there is a space for it. And again, it's definitely something on our mind, thinking about, particularly for first-time buyers, how could interest only or elements of interest only help them? Because to your point, we know that a lot of the time things are only going to improve in terms of income and equity in the property, and it's kind of, is there a short-term kind of need or use for interest only used in a different way versus what we've got currently in terms of what's available? So I would say, yeah, it's an interesting idea and one that we're definitely thinking about. And I would love to hear brokers' thoughts on it and kind of what they're hearing in their meetings with their clients. Like, is there a gap, and how could it help better used in the right way? I don't know, what are your thoughts on interest only?
There's definitely a space for it. We have conversations. I mean, naturally, where I am and the area that I've covered up until recently, we're in Yorkshire. Not everybody's got the benefit of large amounts of equity that they can touch into. But again, there are circumstances where you can talk about it, and it could be a very good option for people. Naturally, if people have been in the market for a long time, people always refer back to 20 years ago when we got bitten by a lot of old interest only, but again, it was a different regulatory environment.
Absolutely.
The controls that were in place around it were not as robust as they are now. So I think like you, there is an opportunity potentially there that we might want to explore.
For sure. And I suppose we're really focused on first-time buyers at Skipton, but as part of that, it's thinking about the other end of the market whereby people maybe want to downsize or want to at least be able to realise some of the equity they built up in their properties, and that's where retirement interest only could play more of a big role. And I think that's having the kind of full life cycle view supporting people who are, like you say, towards the end of their term or who have built up equity in their properties, doing that can directly help to stimulate the first-time buyer market as well. And so thinking more broadly about that into this year and beyond too.
Okay. Question here from Jatinder. Thank you very much for your question. They've put hi Aidan and Jen. Very personable.
Hello,
Lovely.
love that. Good morning.
So Jatinder's asked that they've got quite a few tier 2 visa clients. Would we be looking at potentially moving up to 95% for tier 2 lending at some point soon?
I mean, Aidan, this sounds like a question for you, not for me. Talked about tier 2 visas.
Yeah, I mean, there's no getting away from it. I mean, it's a growing market in terms of there are some lenders that have come into that space. We're currently at 90%.
Yeah.
Naturally, we need to manage the risk across our book, but it might be a conversation. Certainly, we're particularly finding in the new build space, there is a big demand in that area from that demographic.
Okay.
With a lot of new build developments being built close to hospitals, for example.
I was just thinking about that. I was just thinking about maybe for particular professions, that could be an angle to explore. So thank you for the suggestion. We'll have a think about it.
Okay. Well, that is it for the questions on there. So I think we're about at a position where we're probably ready to wrap up.
Okay.
So we will say thank you very much for your time, everybody, for joining us this morning. Or if you're watching it on a playback, if you've not been able to watch it, hope you've enjoyed it. Thank you very much from me.
Thank you from me too. And I would just to add, like, keep doing what you're doing. I know it's quite a challenging time out there and we really appreciate your support, and as do all of your clients, I'm sure.
Thank you very much.
Have a good day. Thank you so much.